Hi, folks. We are just going to wait probably 1 to 2 minutes as everyone gets logged in. And then while we are getting started, if the participants wouldn't mind, just put in the chat box who you are and what part of the Episcopal Church you represent. We'd just love to know the breadth of attendees that we have on staff. I recognize a few of your names from past presentations, but would love to just know where everybody's at. We'll give it 1 more minute. One of our other panelists, Tom Post, is having some technical troubles, but if we have to roll without him, we will. We'll just give it 1 more minute.
Okay. Let's see, you're muted, Sarah.
Okay, so it is my time, 2:02 p.m. I'm going to go ahead and get us kicked off. My name is Sarah Ponder. I'm a regional director at Dimensional Fund Advisors. We're a systematic asset manager that manages money around the globe. Many of you, I'm sure, have seen me and or Tom present at past SEEP events. We were there in February in person before the whole world shut down, and apparently it's September now. So we're really grateful to have everybody here. I asked a minute ago, probably before half of you were on, if you are part of the Episcopal Church, we'd love to have you in the chat box. Just say hello and what part of the church you represent, whether it's a parish or another piece of the organization. I am going to introduce Tom and also Damien. Tom can give himself their introductions as well, but Tom is a client of Dimensionals. He's been one of our clients since 1993. As we joked on our prep call, that's when I was in 3rd grade. I now have two children, so it's been a while. He works with the Episcopal Diocese of Michigan, as well as a number of other clients, and can add some about himself. And then Damien Dormer is our portfolio manager here at Dimensional, who has managed all of our screened strategies, our ESG, sustainable, and then the original socially screened strategies as well for quite some time. He is the resident expert. We have a panel of ESG folks on staff, but he's, I think, probably one of the most well-versed on the intricate details of the matter. So most of the session today, we're going to let him run wild. So I have prepared a number of tough questions for him, where we'll be talking through sustainability investing data, and what it actually is and how investors can use it to make decisions about their portfolios. So with that, Tom, if you've got anything else to add, and then we'll kick it off.
No, I'm just glad to be here with you, Sarah, and also you, Damien. I think this is a topic that is very popular right now in the investment community and in the endowment community, and so it's very timely. I also think there's a tremendous amount of misinformation is probably an overstatement, but just confusion about the whole topic. So hopefully we can shed some light on the whole process that Dimensional goes through, and that we should all be thinking about as we're thinking about ESG investing. So with that, I'll turn it back to you, Sarah.
Great. One more logistical note. So just so you know where I am, I have a laptop with a camera that I'm looking at, but if I'm looking behind, it's because my screen is behind me. So I apologize if that is distracting. So I'm going to share some slides, and then I have some prepared questions, but and I know Tom has some more Episcopal specific questions. If you do have questions, please feel free to put them in the chat box. And I think Tom is going to facilitate them throughout the session. And then we will try to wrap up right before 3 o'clock Central, 4 o'clock Eastern. So with that, let me share the slides, and then we will be on our way. Okay. Can you folks see this sustainability investing data? Give me a thumbs up if so. All right. So, Damien, first question to kick us off. So what?
Shoot.
Oh, go ahead.
Go for it.
Yeah, you haven't introduced yourself. I'm sorry, I forgot about that part. Please.
I actually started off as an engineer. I've worked for Dimensional for 12 years, out of the Austin office for 6 now. Quite a strong focus on ESG these days. And my original training in robotics and accounting is particularly useful when we look at evaluating things like ESG, because it's about taking disparate or unstructured data and then coming up with a clear kind of outcome for investors. So it's been a very, very useful skill set to bring to the finance context and to the renewed interest that we see in ESG. Yeah,
I know your background is not typical of a portfolio manager. So you've not been, you weren't originally trained in finance, which I think is super interesting. That's actually pretty common for our portfolio managers, since we have a lot of folks that started out in engineering, simply because of the way that we manage money is very data driven and engineering heavy. So I appreciate that. And also for those of you who are hearing Damien, no, he's not from here. So he is from Australia. So he's actually worked in a number of our offices around the world, in addition to being in the Austin office currently for the last 6 years or so. Okay, you ready?
Shoot, so you've got control. What question are we asking first?
Okay, so let's start with, so as investors, so the Episcopal Church, has wrestled with this question for a long time. And, a number of years ago, we passed a resolution where we were, attempting to divest from fossil fuels and essentially invest in a more, climate-friendly manner. And there's a number of other issues that are really important to Episcopals, particularly around, the military, civilian weapons, and some others that matter to Christians. So with that in mind, let's just first start talking about the levers. So what levers do investors actually have to pull when they are seeking to invest based on their values? So for us, it would often be climate change and some of those others.
Yeah, so there's it does, ESG and sustainability, it means different things to different people, which is what we're seeing on this slide right now. And there's also different ways of addressing the various topics that are out there. So on the next slide, you can see we've got one approach might be to invest in companies directly involved in an issue. So if you're interested in, for example, green energy or water, there are investment products out there that focus on just those companies. So they tend to be a little bit more concentrated, and there's obviously different sorts of investment risks around them. Dimensional doesn't specifically do that type of investing, but we do the other 3 that are listed on the slide. So negative screening is essentially the opposite. You identify a negative topic, something like tobacco or weapons, and you exclude those companies from your investment philosophy. So you can invest in everything except for those companies. And this has been around for a long time. It's commonly referred to as socially responsible investing. And so it's pretty well understood in the industry and by clients. We can also these days do some overweighting and underweighting. And this gets very interesting because you're changing the weights of securities based on some other external data, and that data isn't necessarily related to that manager's view of returns, be that a subjective view of returns like a forecast, or something more evidence-based like dimensional does, like the investment characteristics of the securities. So, it's really interesting looking at those over and underweighting solutions in terms of what they're actually considering in order to weight the securities. One example would be we actually look at greenhouse gas emissions data, which covers the vast majority of the investable universe. It's a relatively good data set, and so we can use that for overweighting and underweighting in order to further improve the climate characteristics of our investment solutions.
Hey, Damien, maybe some people might not know what you're over and under relative to. So what are you comparing to?
Great question, Tom. It depends on the situation. For the most part, people are going to look at the benchmark. So that would be a market-weighted index like the Russell 3000 or the ACWI IMI if you're looking at a global portfolio. Within the context of dimensional, we kind of create our own indices in our portfolios, and our sustainability portfolios over and underweight relative to our neutral or flagship funds. So it's a really interesting approach where you're not just different to the benchmark because of investment characteristics like size, value, and profitability. You can be different to a portfolio that focuses on size, value, and profitability due to your emphasis on sustainability characteristics.
Got it.
But there's a number of approaches there. The first three are all related to weights, but there's also engagement with companies. We vote proxies at dimensional. We vote them in a green way when it comes to sustainability funds. But there's other ways to influence companies, and some people think this is probably the strongest way is through direct engagement with companies. So we might talk to them about things like DEI, diversity, equity, and inclusion. And that could be gender balance within their company or within their boards, making sure minorities are represented within their company and within their boards. And it's seen as a much more effective way to affect change in relation to specific issues. And so when it comes to our engagement agenda, we will tend to try and rank in the short term some priorities for us to address through either direct engagement with companies or through letter writing campaigns to boards. And obviously our proxy voting policy is public, so that's more of a permanent approach to engagement.
Can you, just to build on that, give an example of the type of thing that we would specifically ask a company to either do or change or disclose?
So a lot of our work with governance or engagement has typically focused on what I would call harder economic principles. So things like poison pills, which are like a protective mechanism for boards to keep management entrenched. They might be related to management compensation, which is, usually when the stock market's not doing well, people start seeing how much executives are paid, and there's a renewed interest in management comp and the mechanisms and metrics by which it's measured. So they're two very traditional approaches. More recently, we have been looking at things like lobbying. So a letter writing campaign in order to ask boards at what level they are signing off on lobbying spends within the company to make sure it has the correct amount of oversight.
Great. What kinds of climate-related things would we ask, particularly in a sustainability type portfolio?
Yeah, there's a couple of things we've been doing. We have asked for increased disclosure in some cases, and our approach to that revolves around looking at the largest emitters, also the largest companies, and seeing whether they had policies around disclosure and whether their disclosure was sufficient. And in some cases, what we'll do is we'll look to external NGOs and their evaluations, and we'll consider that when we go to write a letter campaign or to engage directly with them.
So given that, oh, go ahead.
We had two questions coming from the chat. I think you touched on it briefly, Damien, but because you mentioned diversity as being one of the things that you might choose to engage, but someone is just wondering if racial justice fits in with your dimensional, definition of ESG investing, and how might you advocate for that?
Can I actually add to that question, Damien, and kind of make it even more broad? So when we think, that issue, or say gender diversity, or really anything else that is, not necessarily revenue related, how can an investor even evaluate any of those topics in the first place? And, what kind of data even exists for us to use on those types of topics?
Yeah, so what we've got here is the confluence of kind of two sets of concepts. One of them I would broadly put under the available data, and the other I would put under the appropriate mechanism for action. Now, to Tom's question, actually it's from Betsy, I believe. There is a lot, obviously, going on in the US and in other countries around racial injustice at the moment. And for some, it's very controversial. For others, it's kind of a free kick. Now, the thing is, because ESG tends to get a number of kind of recent issues swept up in it, it's very difficult to take Dimensional's approach to address that issue in the short term, because generally speaking, the data isn't strong in that area. So that's the data perspective. And then secondly, the mechanism for action is probably more effective in other ways. So let me explain what I mean by that. Thousands and thousands of people have been protesting on the street, and you've literally in months seen changes in the policies and the funding of certain activities, be that police or other things, and the way people are looking at how they vote. Both of those things, like direct action and voting, are far more effective at affecting change in society than the exposure that your portfolio has to a particular asset class or particular set of securities. That's not to say that it's not important, because it's really interesting to look at the chain of events that can occur in order to affect change in society. Tobacco is a clear example here, where in different countries, the journey is at a different point. So in some countries, tobacco is heavily regulated with plain packaging and high taxation rates, and is subsequently consumed a low. Earlier in their journey, the same regulation is not in place. And the way that regulation has gotten in place isn't necessarily through the investment context. It's through NGO organisations, it's through direct action from the public and different community groups, and it's also from the way people vote and their elected leaders. So ESG tends to, some people will position ESG as the silver bullet, if you like, for all of society's problems. But practically speaking, and as an engineer, you have limited resources in any situation. So it's impractical from the get-go to think that one approach can solve all problems. So what we're trying to do at Dimensional is to come up with investment solutions that do two things. They're very effective long-term investment solutions. People shouldn't have to contravene returns or accept reduced returns in order to still be invested in line with their values. And the second part we're trying to do is making sure when we do those investments, we make the most of our power, if you like, our ability to engage, and the way that we're transparent with investors about the way the money has been invested.
Damien, two things. One point I'll just tell the audience that you're making reference to different countries. The reason for that is that you guys invest in not only U.S. companies but also companies from around the globe. So there is this range of possibilities when comparing practices around tobacco in Europe versus the U.S. versus Asia. So, and then the second thing is that we had another person say, in what areas has ESG investing actually made a measurable difference? Is it possible to quantify the impact? I think you were unpacking that a little bit just in the comments you just made, but are there any academic studies on that front?
So it's a really interesting question, and in terms of our earlier comments about kind of greenwashing and understanding when marketing is a play versus the real outcomes, we do see a lot of investment managers use the word impact, and I prefer to use the word exposure for our funds. It's not that we don't have any impact. We can certainly, to some extent, influence the cost of capital of companies by choosing to invest in them or not. But it's important to understand that for the most part, we're talking about the exposure of the portfolio, and a secondary part is if we're able to influence companies through direct engagement with them or proxy voting, then that has a kind of preliminary impact on business behaviour. And when most people talk about impact, they're actually talking about the actual impact in society. So there's like a number of chains, a number of links in this chain, and we impact some of the earlier links, but most people want to measure maybe the last link, right? Where does the chain end up? So there's not great empirical research about the way people invest their money and then there being great change in society as a consequence of that. Certainly, if you have what's known as a impact investing portfolio, one that is positive screening and invested with the understanding that there is a trade-off between risk and return, which you'll have potentially lower risk and return, lower returns as a consequence of your concentration in that particular activity, then I think you can more easily paint that picture of impact. But what we're doing here at Dimensional is we're bringing an investment philosophy that's tried and true. It's very transparent, and where people don't have to make that trade-off. And at the same time, they're not investing in the worst offenders in terms of the problems in society.
Yeah, and I think you said it best when you said making your investments align with your value system. And Episcopalians, I think that's important to a lot of us in trying to at least be representative of our faith commitment and our commitment to justice and the like. And so while the impact is hard to measure, we at least can say to the rest of the world that we're trying. And I think that's part of it.
Absolutely.
Yeah, I was going to add that it completely separate from a public mutual fund type of portfolio. I hear a lot, usually community foundations or similar type organizations that I work with. They have 1 to 3% of their total AUM or their total asset pool invested in impact investments. Often it's stuff like low-income housing, water quality in their area, that kind of thing. And so of course, like those types of investments they absolutely know what the trade-off is, and they know where the clear social benefit is. And so we're really just talking about two totally separate types of investment. And, of course, we know that the, softer social issues, particularly around, gender, race, and all of those things, they're just very hard to evaluate from a data-driven perspective. Quite simply,
but the expectations in society are no less valid, right? And so there's opportunities there to essentially have those discussions with boards about how they're addressing those particular issues. And actually, if you look at the recent announcements by a number of large financial companies, they're being more assertive about how they address those. So that there is change happening, and I would say that that's been driven by the public.
Yeah.
By public protest, which has been extensive in the last few months.
Yeah. I mean, just, anecdotally, I feel like that's kind of happening on the investment front too. I mean, as, climate change has become, more and more real, in people's faces, you're seeing more and more money going into these, types of funds. And then, one more thing on the, how to actually measure. So of course, softer things like, employee makeup and board makeup. Board makeup, I think eventually there could be some better data around. But in terms of climate change, we actually do have pretty decent data around emissions and are able to actually have a quantifiable impact. So do you want to talk a little bit about that within the framework of, can you discuss the difference between subjective and objective forms of evaluation when you're looking at a company's ESG measure?
Yeah. I think that's really important. So when we look at the disclosures by companies, that you can really kind of class them into two groups, subjective and objective. Under the subjective heading, you would put things like their policies, their stated intentions, and maybe their forecasts. So these are things that maybe they've committed to, but you're not sure if they're actually going to succeed or not. And they are subjective, so they're not measured necessarily in the same way. Now, what happens is over time, as people get more interested in those topics, generally people will measure them in a more objective way, in a more standardized way, and they'll actually make standards in order to do that. And we see a lot of those standards in sustainability, things like PRI, which is the Global Reporting Initiative, or the US Sustainability Accounting Standards Board. And there's a whole lot of others, and they come up with standards in order to turn this subjective analysis or comments around data into something more objective. And so when we look to evaluate or change weights of securities in the funds, we'll look at things like revenue and assets, which are obviously already measured by the accounting standards. In a material and repeatable and comparable way, and then that gives us the ability to be sure that the way that we look at an issue now in terms of those output measures can be inputs or outputs, but they're objectively measured. We get a lot more certainty around the nature of that issue. We can compare it to the size of that industry to the rest of the market. We can look at the way that industry's market cap compares to the rest of the market. We can look at its investment characteristics, and we can look at how it would basically impact a portfolio in terms of diversification or its changes in sector weights. And so, like when we think about climate change, we have two main sets of data there. We have greenhouse gas emissions, and we have carbon reserves, so coal, oil, and gas. And Yeah, if you switch to slide 6, that'll help out. So there we can measure the coal, oil and gas from the financial reports, and we can measure greenhouse gas emissions because there's been standards in place for about 20 years now. And roughly half of companies are using those standards in order to disclose their emissions. And so now we have a data set where we can objectively say your exposure in these portfolios to current greenhouse gas emissions and also to potential future emissions are at certain levels. And if we look at the if we look at the energy sector, you can see that obviously those investments have done poorly over the last decade, and so that's actually boosted the returns of more sustainable funds. But clients can see very clearly that the benchmark has a certain level of emissions and exposure to carbon reserves, and in the portfolios have a different, much lower level.
Hey, Damien, one of the topics that comes up in the Diocese of Michigan is the potential trade-off between this value alignment and maybe our fiduciary duty. So, or not maybe, and our fiduciary duty. So I think in the past, people have said maybe you have a lower expected return if you pursue an ESG strategy. You just mentioned that oil and gas have really not had as good a return as the overall market in the last 10 years. But how should we think about whether there's a trade-off or not, and how does Dimensional sort of deal with that?
So there's a number of perspectives there. So we could look at it from like a sustainability practitioner perspective. We could look at it from an economic theory perspective. We could also take an empirical lens and what the data tells us about these things. So let's start with sustainability practitioners. So we're talking about a circular economy here, where we get kind of more inputs for either lower or the same, more outputs, sorry, for the lower or the same input. So you're improving the efficiency of the system. And often when we think about products, it's like, that doesn't sound like a great way to make money, right? Like being better at producing something may help you, but it's not going to be necessarily a long-term business if it's a real circular economy. So even though sustainability practitioners would like to think that, yeah, there's going to be great returns from investing in this, it doesn't necessarily seem obvious from some of the core concepts there. But that's not really important. There's so many other things coming into play here. From an economic perspective, you might have additional regulation or taxation or litigation. And I think tobacco is actually fairly illustrative here. So even though it's a very, very profitable business, those other levers that can be pulled, regulation and taxation, can be very powerful. Like they can simply wipe out markets or tax them out of profitability. So when we think about it from an economic theory perspective, often ESG is associated with lower risk businesses. They're lower risk in the sense that they're unlikely to be taxed or regulated out of existence. At the same time, let's say our approach was just to screen out some companies. Some people would take the view, and this is partly because of tobacco, that if you exclude those companies, then your returns are going to be lower. And so there's kind of like a trade-off with diversification there. So I think there's actually good arguments on both sides when it comes to the economics debate. You can lower risk by not having exposure to potentially negative regulation and taxation, but at the same time, you might reduce diversification. And that's pretty much the same approach that Dimensional takes. So when we look at an issue, we will try and look at how we will impact diversification. But on the other side, like so in a potential negative there, and on the other side, how we will avoid those regulatory or client-related risks in terms of reputational or litigation issues. So there's basically a bit of a seesaw, and we need to have a good way to do that. Actually, and the way that we do that is to engage with clients directly. So we have like a sustainability council, and we discuss the various issues with them, and they help us rank the issues from their perspective in terms of what's most important to address in the fund, which can help given that there is limited data and we're dealing with some subjective views.
Yeah, so I just want to bring this back to, we may talk about this data maybe a little bit later, but I mean, the long and the short of it is that if you just look at index data outside of any funds, if you are just doing a straight cut of removing utilities and energy, you're going to see roughly the same experience with roughly the same standard deviation. And so, this kind of tells you that there's probably not, either an upside or a downside to it, as long as you're not, severely reducing diversification and cost, or in increasing your cost on the fund level.
So to put that from a perspective of an investment committee, you're when you're aligning your values with your investments, you're not necessarily not paying attention to your fiduciary duty. They can all be compatible.
Yeah,
that's right. And we're able to do that. We're able to show it here with this result, Sarah. So you're absolutely right. In a proper unbiased study, of the longest length we can do, if we exclude basically all of energy and utilities as proxies for the most polluting companies, then the returns end up basically, in a very similar place to the market. The T statistics you see on this page are not above 2, and so this is not a significant outcome for investors.
So I want to touch on, I want to repeat 2 things that you said. So first is when we were talking about subjective versus objective data. I think the clear point to take away from that is that when you're trying to evaluate a company, you want to literally see if they're putting their money where their mouth is. Because as we know, anybody can write a press release. Anybody can form, an internal committee to improve, this, that, or the other. But what we want to see is them actually making change that impacts, the issue, both from the company's front and from the investor front. So that's what we really mean when we're talking about subjective versus objective data, and that's why looking at revenues and assets and investments actually tell us if a company is just quote unquote greenwashing, putting out some stuff in the media saying that they're doing, this, that, and the other, but spending, a fraction of a % of their assets on actually, going towards that, that goal. Then the second thing that I wanted to repeat is what you said about, sort of the definition of sustainability from an economic perspective, being that truly, when you just think about the word itself, it's using the same or less inputs to create the same or more outputs. And in economic theory, that's an equation for wealth creation, and is generally what people want out of their economic investments. And so. Yeah, so I was wondering if you could talk about how sustainability potentially impacts a company's value. And we can talk through, this, I think this would be the slide you'd want to talk through on that. Is that right?
Yeah, I think that's a really interesting fundamental question because, we know that there's there's basically a lot going on, but also, it's possible for people to view it in a positive or a negative side. But what we find from the empirical studies and also the general research around ESG issues and markets is that ESG information is incorporated into prices in the same way that other financial information is. Right, so financial and non-financial information gets incorporated into prices where it will impact future cash flows or future risks. And so that's important when it comes to our investment philosophy because it matches and it means that when we look at ESG topics, we want to look at them having thought about what we already know about markets. So, for example, if we're looking at an ESG topic, some people might say, it has an impact on returns. It's like, well, if you consider what we already know about the things that impact returns like profitability or size or value, then maybe that effect will go away. And actually that is actually the case. So we see a number of different data providers producing reports suggesting that there's positive impacts with ESG scores. Those scores are subjective, and so that makes us question the result. Now, a lot of what's happened recently in sustainability and ESG has been related to the underperformance of energy, and so that a lot of those results kind of play off of that outcome. Now, when we look at the underperformance of energy, we can actually explain it in a different way. If we look at the emissions from energy, they're very high, and we can look at the correlation between emissions and profitability in funds. So actually, once you correct for profitability, you find that the significance of those results tends to go away. So it's not actually telling us anything new about returns. It's just an outcome of what we already know and the market's doing their job in terms of pricing information.
Very deep.
Yeah, it is really interesting. So, I mean, when we try and evaluate the best data set that we have about sustainability, it is an emissions data set. It's about 15 years long, and it covers the majority of securities. And so it's a reasonable data set with which to ask that question. You know, are emissions related to returns? And what we find is that they are, but only if you're not correcting for profitability. It's actually that returns are related to profitability rather than emissions being related to profitability.
So essentially, as it happens, the energy companies, at least recently, have become less profitable. I mean, we all know what's been going on with the oil price recently, and that in turn has lowered their share price, which also has had that. So it makes it look like it's got that correlation.
Yeah, that's definitely one way to view it, but it's also a subset of what's actually happening. So what's actually happening is that higher profitability companies are doing really well and independent of sector.
Yeah.
Could you also make the argument, Damien, that that some of these things that we worry about collectively are a priced risk? In other words, climate change is going to impact a lot of different businesses, and that is being filtered into the price that investors are willing to pay for a stream of earnings, or however you want to define it.
Yeah, absolutely. So there's no question that some of the risks in climate change are priced. So, and what I mean there is they're priced on probability, and there's still uncertainty around what the outcome will be. And we see this with all sorts of issues, not just climate change. You see as the market, as society gets more certainty around information, around a given outcome, then prices react, and they react very quickly. And the uncertainty in climate change is obviously uncertainty in the potential future temperatures and what impact that will actually have. But obviously we're seeing more examples, individual examples, which form a trend, which support the climate science, and so the market generally is starting to take that more seriously. That the probability in its eyes is changing. But yeah, I think that there's definitely these things are definitely priced. They are not fully priced, right? They're not priced at a probability of 1, and so that's where we can fit into the discussion the concept of the externalities, right? So there are some externalities that are not particularly well priced at all because they're not going to impact company revenues or risks, right? So in those cases, what you would do is you try and influence the issue through engagement or through direct action and voting.
So we didn't talk about this beforehand, Damien, but this weekend I was listening to a podcast about the fires on the West Coast and how, at least this is the theory, is that potentially the sort of cold-hearted outcome could be that the insurance companies who insure the homes in the fire-prone regions end up just pulling out of those fire-prone regions. So effectively, the market is pricing in that climate change impact. And so I'm just curious if you know anything about that, has that come across your radar at all?
Yeah, so it's interesting. I think that it's fair to say that the market has limitations, right? I mean, there needs to be reasonable regulation around things in order for markets to work well. And so a number of central bank heads and other prominent economists can see that the potential risk to the insurance industry is very significant.
Yeah.
And in fact, when they don't see the survival of certain sectors and certain sorts of insurance. And so, I think in the face of those sort of risks, and this is public information, so people are aware of this. People who will be acting on it in the markets are, this is priced information. But at the same time, there are going to be a range of views, and obviously the potential for loss is pretty extreme. This week we've seen the fires out in California, and in previous summers, and earlier in the year we saw the fires in Australia, which were devastating. I think the ESG sometimes gets talked about in terms of tail risk, and obviously we've seen a number of those come to bear recently.
Yeah, we've got a few more minutes. I have at least one more question, but if anybody else does have questions, please do feel free to put them in the chat box. I'm able to see it, and I know Tom and Damien can see it.
And Sarah, maybe just say out loud that these slides are going to be available sometime next week, probably. Right?
Yep. I put this in the chat. So our compliance department has to review the recording and review everything first. So that's usually about a week turnaround. So you'll get an email from me at some point, probably by the end of next week, with the recording and the slides. So just to kind of cap this off, there was one slide we didn't look at closely. I can't remember if it was this one or this one. But Damien, we have talked a lot about particular climate change issues, you and I, and where they sit along the value chain, along the supply chain. And so can you discuss just within any particular issue, but particularly around fossil fuels and climate change, can you talk about how we can even determine where along the supply chain to make an impact and what trade-offs to think about?
Yeah, absolutely. So, so what we'll do when we start off looking at an issue is we ask the question, do we know enough about this? And, you know, as finance professionals, we're not experts in everything. So we go out and get that information from experts, from academia, from people involved in the industries. And if there's sufficient objective information out there in order to evaluate the issue, and there is in climate change, right? You've got greenhouse gas emissions, and you've got potential future emissions. So you can evaluate current behaviour as well as future behaviour or future risk. And so, so then we will look at the way that information or that data is represented through the value chain. And in climate change, for example, you've got, you know, very high risk in terms of the utilities with their current emissions. You've got exploration and production companies in oil and gas and like diversified energy companies. They're obviously a very high risk as well, and we've seen their prices obviously react to oil prices and drops in demand and things. So we can look further up the chain, the distributors and then the retailers, and they're less risky because they can potentially distribute other things or change their business models, right? And so that the assets aren't necessarily as tied to that industry as the very specialised equipment and oil platforms, things like that. So so in the kind of middle and end of the value chain, you tend to see less intensity and also more of a chance of repurposing assets and things like that. So we would tend to treat them in that way. So we would tend to exclude the ones at the front of the chain, and then the ones in the middle or at the end, we'll tend to weight them differently, but not as strongly. And then for those companies that have maybe some purchasing power, we might use an engagement approach in order to make sure that purchasing was done in a reasonable and effective way.
Yeah, can you also talk about palm oil? That's a climate change topic that I didn't know a ton about, but apparently is incredibly important. So you talk about how that works, value chain.
Yeah, the supply chain in palm oil is really interesting. So palm oil is a very productive crop in terms of its oil production, but at the same time, it has some really negative consequences for the environment, for biodiversity, for emissions. It's very prominent in Malaysia and Indonesia, and it's kind of being moved around the world at the moment in order to get away from the restrictions that Malaysians and Indonesians are now placing on it. So you start off with farms and that actually grow the palm fruit. You have mills which produce it into oil. There are oil traders and distributors, like large commodity traders. And then you have consumer goods companies that are taking that oil and selling products to consumers. Now, we tend to exclude the farms and the mills because what we've seen is a lack of progress in terms of their behaviour and risk management over time. And we're not expecting that to change in the short term, even if we were to engage with them. In the middle of the chain, we're seeing the distributors and the commodities giants. They are essentially not being effective in terms of passing down that like greener practices and better management of farms and farmland. And so, so that leaves us with the fast-moving consumer goods companies that are actually buying that palm oil off them, and they are a potential engagement target there. So if the purchasers of the palm oil are demanding certain levels of sustainability and transparency in their supply chain, then we can essentially pressure the other parts of the supply chain to have good practices. And our goal here isn't to tell them what to do. It's to encourage best practice and to encourage sufficient and appropriate oversight of the risks. We've obviously got a varied approach based on which part of the supply chain is involved, and you know, in the long term, hopefully we can have more success with engagement, and just by having it in the portfolio, there's also an element of education which happens with the public, and by having it as part of the public discourse, then there's ways that the public can also be involved in affecting change.
Yeah. Any final questions? I'm going to try to summarize all of these thoughts. Tom?
Oh, go ahead.
Okay. I'm going to stop sharing since I know we're all probably very tiny on your screens. Okay. So move my little glasses. When I'm on Zoom too long, I gotta have my, anti-headache inducing glasses. So, as an Episcopalian myself, these are obviously things that I care about a ton. And I'm very grateful that I've actually learned a lot, both from Damien and from Tom, over the last year about just how and why we think about all these issues. I personally have money in the sustainability funds, just because I know that, I'm got a couple of kids, and so it matters to me that, there be clean air and water and all that stuff for them as they grow up. So just to recap a couple of the questions and topics. So we as investors have the ability to impact companies generally on their policy, by engaging with them and asking them to continue to disclose and continue to improve, operations, particularly around these issues. We also think a ton about the places along the supply chain, the value chain that can actually have impact. And so we discussed the, like the top line folks, like say Unilever or, other, consumer brands. They have, varied sources of revenue and assets. And so we want to really look at where any of these companies are actually placing their money in an objective fashion, because we know that where the money actually is going and how the money is actually being spent is, more of an indicator of what the company's values actually are and what its trajectory actually is than its policies that it puts out. And then, hopefully as companies put out policies, that then over time leads to change. But, in the moment, generally a policy there's still some time before those policies bear fruit. The other big thing to remember is that when you're talking about sustainability with your parishioners and with your committees, think about it just, in addition to the climate change and the social impact, think about a couple of things. First, on social impact, the nice thing about issues such as civilian weapons, palm oil, and those other tobacco and those other types of issues, the nice thing about them is that there's actually a relatively limited number of companies that engage in those issues in a significant manner. I don't remember exactly what the number is of American civil weapons manufacturers that are actually public companies. I think Damien told me it was like 7. It's a relatively small number. You tell me.
Most issues involve a relatively small number of companies relative to the securities universe. And so our portfolios invest in roughly 15,000 names globally on the equity side, and there's obviously thousands of bonds. So nearly, like virtually all issues can be dealt with through exclusion without having a big impact on diversification. That's as long as you don't choose a list that's, you know, all the things that get done by companies, right? Like most people see that companies are providing goods and services to society and they're a positive generally. And so we like to make sure that we're making a good trade-off between companies that do many things. You know, we're not going to strike them off the list just because there's like 1 or 2% of their revenue that's associated with something negative.
Right.
But if something's significantly involved in one of the worst issues, then that's obviously a candidate for exclusion or some other sort of action.
Yeah, so that's the nice thing, is that the vast majority of social issues, there's just not very many public companies that are impacted. And so it's very easy to screen them out. So prison REITs, for another example, there's only 2 or 3 of them.
If you had to summarize it, you'd say companies are great. You know, companies actually do lots of great stuff for society, and they're very beneficial and very efficient in their use of capital. So it's not like companies are the enemy. Like they're actually very positive mechanisms for helping run society.
Yeah, I mean, I think it's been fascinating and really encouraging over the summer when, you know, we started to see, you know, this next big wave of civil rights demonstrations. I mean, I personally think that the fact that corporate America responded in a really strong way, and, you know, at least is starting to like make statements and policies that's showing that the needles are moving.
Yeah, and we're going a little over time, but, you know, corporate America is, in a way, you know, it's in its own self-interest. So it's the people that will end up influencing its policies ultimately.
Yeah. And the last thing I'll say is just about so climate change itself and emissions. You know, the key thing to keep in mind is that, of course, that, you know, sustainability economics equation, the, you know, same or less inputs to get same or more outputs. That's an important concept for committees to understand. The second thing is that when you are evaluating how climate is being put into a portfolio or removed from a portfolio, you know, it's a supply and demand situation. It's not just a simple screen out the 7 tobacco companies kind of situation. And so, you know, we have to think about what our role is as demanders of energy, and then what can we do in order to impact the suppliers of energy. So it's both of those sides of that coin are incredibly important. Those of you that have heard me talk on this topic before, I go like really into the supply and demand because it's important. And, you know, that gets back to the final point, which is that, you know, yes, we can invest our money in a way that, you know, shows our values, but also we have to use our voices and we have to vote the way that, you know, matches our values. And those things are going to have, you know, just as much, if not more, impact on those issues. That's all I got. And final thought. Okay. So let's see. There is a survey in the chat. There's a Survey Monkey. So if you wouldn't mind clicking on that and taking that survey, we would very much appreciate it. We will again send out the recording and the slides once they both get compliance's final stamp of approval. We are a financial services company, so that is just part of the deal these days. With that, thank you so much. We very much appreciate your engagement. I hope you guys have a good.
Yeah. See you later, Sarah and Damien. Thank you.
See you, Sarah. Thanks, everyone.